All right, let's talk about Dave & Buster's, ticker symbol PLY. They just dropped their earnings report and wow, the market's reaction was an absolute bloodbath. So today on Talk Tickers, we're going to do a full post-earnings autopsy. We're going to dig in and figure out exactly what happened. And when I say bloodbath, I mean it. Just look at this number. The market's verdict was swift, it was brutal. Right after that earnings call, the stock just fell off a cliff. It absolutely cratered, closing down a stunning 16.7%. And that was on huge volume, folks. So let's start right there with the collapse itself. Because look, a drop this big, that's not just a whoops, we missed by a little. No, this signals a major fundamental shift in how Wall Street is thinking about this company. So that brings us to the big question, right? Why? Why did the market hammer play so hard after this report? What on earth did investors see, or maybe hear, on that earnings call that completely spooked them and sent everyone rushing for the exits? Well, what spooked them? You know, as it so often does in this business, it all starts with the numbers. And this quarter, the numbers that really matter, they weren't just a miss. They were a huge miss. Okay, just take a look at the scale of this disappointment. The revenue number, it was a little light, but not the end of the world. But the real damage, the thing that set off all the alarm bells, was the bottom line. Adjusted EPS, earnings per share, came in at just 40 cents. The street was expecting 92 cents. That is a staggering miss. We're talking less than half. That's the kind of number that makes analysts just rip up their models and start over. It forces a complete reevaluation of the stock. And then there's this, which is maybe even more telling. You need context, right? So the broader casual dining sector, their competitors, they actually grew. Same-store sales were up, on average, over 4%. Dave & Buster's, they went completely the other way, down 3%. So what does that tell you? This isn't just about a tough economy hitting everyone. This shows they're actually lagging behind their peers, which points directly to problems inside the company. Okay, so the numbers are bad, really bad. The natural next question is, what's the plan? How are they going to fix this? And that brings us to the new CEO's playbook. There's a new person in charge, Tarun Lal, who just took over. And boy, is he tasked with a major turnaround. And you know, Lal was incredibly direct on that earnings call. He didn't dance around. He didn't make excuses. He came right out and said it, quote, "I believe there has been a very clear executional failure that will be rectified." You got to respect that. That level of ownership of just admitting we messed up is exactly what investors want and need to hear from a new leader who's walking into a fire. So this is what he's talking about. This slide lays out the full strategic reset. On the left, you can see what wasn't working, and it's a lot. They'd pull TV advertising, their promotions were all over the place, they cut the number of new games by a whopping 80%. Just a mess. Now look at the right. This is the back-to-basics fix. TV ads? They're back. Promotions? Simplified, like the eat and play combo everyone knows. They're committing to over 10 new games a year, and they're revamping the menu. It's literally a complete 180 from the old strategy. And this right here, this sets up the classic battle, the core conflict for anyone even thinking about investing in play right now. It's the market's deep, deep skepticism about today versus management's big promises for tomorrow. So here are the two competing stories, laid out plain and simple. You've got the market's view, which is laser-focused on what's happening right now. That huge earnings miss, the negative sales, the shrinking margins. But then you have management's view. They're basically saying, hey, give us some time, trust us. They're pointing to their strong cash position, over $440 million, and this clear, actionable plan to fix what they're openly calling self-inflicted wounds. So you've got the market's pessimism on one side, management's promises on the other. As analysts, our job is to figure out which story holds more water. And that brings us to our official call on play. All right, here's our prediction for the next earnings call. First, the Q3 results. We think stabilizing those same-store sales is still going to be a huge challenge. Look, these kinds of turnarounds just don't happen overnight. Second, the price action. Get ready for more volatility. This stock is going to be a total battleground between any good news on their execution and any bad news from the broader economy. Which brings us to our final rating, market perform. The turnaround story is plausible for sure, but the risks in the short term are just too big to ignore. Okay, so given that whole dynamic, how might someone actually trade this? Let's just walk through one potential idea, purely as a thought exercise, of course. Now, one way an investor who kind of believes in this turnaround but wants to cap their risk could approach it is with an options strategy. something like a long-dated bullish call spread. Basically, you're setting up a trade that pays off if the stock recovers over, say, the next 12 to 18 months. It's a way to bet on the CEO's plan gaining traction over time, but in a way where you know exactly how much you can lose. You're capturing that potential upside without, betting the entire farm today. And of course, I have to say it, this is just one example. This is not financial advice, but it all comes down to one question that every investor has to ask themselves. Do you believe these are just self-inflicted wounds that a new, competent leader can fix? Or is this a sign of something deeper, something more fundamentally wrong with the business? That, right there, is the multi-million-dollar bet on play right now.